Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We are advantaged at Bloomberg with a gentleman who's done a tour of duty in government at the White House, directly at the White House, in Bloomberg Economics. And then umpteen years ago, somebody said, let's put Brendan Murray in charge of trade. And he has begun absolutely definitive for not only the usual show up and throw up verbiage on trade, but anecdote and actual what's going on the ground. Brendan Murray from a cornfield in Iowa. No, I'm kidding. He's at Queen Victoria Street in London and joins us this morning. Brendan, you got a great article about Republican farmers in Iowa going, what in God's name is going on? What did you learn in your reporting on Iowa corn and their future?
Well, yeah, Tom, there's going to be a lot of focus today and in the days ahead on the automobile industry, on electronics and energy and food, and a lot of these major products that move back and forth between Canada, Mexico, and the U.S. But if you look at in the heartland of the U.S., at American farmers, one of their key products was something that China retaliated against today, and that's soybeans. And soybeans are, kind of a pretty basic sort of commodity. You can grow them in Brazil just the same way you can grow them in Iowa. And the farmers in the Midwest, and in Iowa in particular, in large blocks voted for Trump. But at this meeting that we've seen some reporting on, they're not happy about this trade war that Trump is starting. And if you alienate China as one of their main customers, that's not good for them. And of course, soybeans prices fell today. So in the grand scheme of things, autos and electronics are much more economically important, but politically, the president needs to hold that base. How loudly are Republican farm state senators going to applaud tonight when he says,
let's combine the Brendan Murray magic here. There's a guy named Grassley who's 114 years old. I adore the guy. He sounds like my grandfather out of Ames, Iowa. Iowa City, Iowa, years ago. Brendan Murray, what is Senator Grassley going to do to sit the president of the United States on? Grassley's sitting there at the desk with Kevin Hassett with a Pennsylvania PhD. What do they tell the president?
He's going to say, he himself would say, look, I'm in the minority on this position, on this free. The Republicans used to be the party of free trade, opening markets abroad, and that kind of thing. And he'd be the first to admit that he's now in the minority in that, with that view. So my guess is he would talk to the president about some sort of farm bill, some sort of assistance to give farmers the way the farmers got the help during the Trump's first term to offset this loss of income that they're looking at. It's not just the sales to China that are going to be affected. It's farmers import this thing called potash, and it's for fertilizer, and they're going to have to pay more for it now. So planting season, so it just kind of hits them on both sides. Grassley is going to say, if you're going to go this route, then farmers need some welfare essentially.
Here's the difference.
In a farm
Okay,
bill.
Brendan's a city guy, and he's talking about this thing called potash.
Right.
Jess Menton has lived potash.
Right, College Station, Texas.
Get a question in here to Brendan Murray.
Well, because Brendan, you were just talking about how when it comes to the tariffs impacting more electronics and autos, but at what point do you think, and how long before we could see changes when it comes to the price of consumer goods at the grocery store?
I mean, it was just Target's CEO was on the airwaves today saying that customers could see price hikes within days, and he's talking about strawberries, avocados, bananas, vegetables, the kinds of things that the U.S. depends a lot on Mexico for. So they flip the switch to turn the tariffs on, and companies say, I'm suddenly paying 25% more, and they just pass that on to consumers. So I don't know how you stockpile tomatoes because they don't exactly last that long. But you got to figure that tomatoes are going to be 25% more expensive next week.
Brendan, keep writing with your team these anecdotal, real articles about real people and not people in bow ties going to 3 decimals. By the way, Brendan, if you go to Michael Barr's refrigerator, you will find aged tomatoes.
And you won't find chicken paws. You're going to find chicken feet.
Brendan Murray, thank you so much. Driving all of our trade coverage, one of the jewels of Bloomberg News.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Right now, with substantial acclaim, Barbara Reinhard, CIO at Voya Investment Management. Barbara, you wrote your usual 10,000 words. I'm kidding. It's all brevity here. Let me quote, folks, the single sentence from young Reinhard. I'd be buying equities. Mm-hmm. Is it buy the dip or is it more sophisticated than that?
Well, I think there's 2 things, Tom, that are really important for everyone to know. Number one, positioning is is more on sides at this point. So coming into the year, you had big positioning. Everybody was running equity overweights. Big year last year. A lot of that positioning has been taken out of the market right now. So that's number one. Yeah. Number 2, sentiment. Short-term sentiment indicators are very oversold. Those are contrarian indicators. S&P versus ag is down over 6% at this point, and you're seeing some fear into the market, which is generally when it's a better time to start adding to equities.
That's interesting too, because Tom and I were talking earlier about how Emma Wu at JP Morgan, actually NVIDIA was contributing to the buy the dip inflows when it came to retail investors, but they did see them actually selling names when it came to Tesla and Apple. So we were talking about sentiment at extremes. I mean, the bull bear spread last week for AAII was the lowest it's been since 2022 and hovering around those lows since 2009. So are your clients going in and asking to buy?
Yeah, I think it's short-term sentiment indicators are definitely oversold. The medium-term ones are hanging a little bit more towards neutral. But unless you're going to have a recession, your short-term indicators generally give you a very good risk-reward opportunity about legging into the market. It could be that you go lower over the course of March and then some seasonality really starts to pick up into April. But we think that it's difficult to time it. And when you've got weakness, it's good to buy in unless you think there's going to be recession.
I love the phrase legging into the market. I have no idea what that means.
That means buying across the dips.
Across the many dips. Being brave here. Futures negative. My eyes are failing here. Negative 40 on the S&P futures right now. So we have to readjust. We have to recalibrate. And it's not a day for simplistic equity questions. Are you factor choosing this morning? Are you like securities analysis, Graham, Dodd, and Cottle choosing? What's the method to make the marginal acquisition?
I think it's difficult to step in front of momentum at this point, right? Momentum's had a massive run. After you've had big runs like this, it's difficult to see that it would be able to do a three-peat of it and have it 3 years in a row. I'd be more inclined to buy things that are more value oriented, not internationally. I think that Europe is way over its skis at this point. For Europe to continue to outperform, you would need to see earnings beat outpacing the US like they did in 2017. That won't be the case, or at least we don't think it will. So I'd be buying things that were much more value oriented. If you really want to go bottom picking, look in the small cap universe. It's down over 12% at this point. So it's really gotten quite hammered, even though the fundamentals don't look to be quite that bad. It's
such a tough space because that's the ongoing debate for years when you think about whether it's the Russell 2000 or the S&P 600, and especially the 2000, just given the amount of zombie companies close to all-time highs in it. So, I mean, at what point is that really going to be more of a longer-term buy than something that you just step in and buy on the shorter term?
Yeah, the longer term, the key to buying small caps, and it's usually generally in the S&P 600, if you're coming out of a recession. So if you're halfway through a recession, ISMs have bottomed. You're starting to see the uptick from something akin to 40 to 45 on the ISMs. That's generally when you want to buy the junky stuff. That was the 2020 small cap rally. It was really led by the junky stuff.
I haven't even brought this up yet today because I'm as you know, folks, I'm death in the dots. I'm death in the parlor game of the Fed. But, Jason Furman's on fire this morning out on Twitter. And there has to be a Fed reaction, except the question, Barbara Reinhard, are their hands tied?
It's going to feel stagflationary for a little while. You're going through the markets right now. They're going through a proper growth scare. Tariffs are only going to exacerbate that to the downside. And when there's a lot of uncertainty, what do corporate CEOs and treasurers do? They start to pause. They put out decisions. They say, we're going to decide on hiring later this year. So that could get U.S. GDP growth down to sub 2%. But you would need a significant shock to get it below 1%, which would really kind of start skating along the lines of a recession. The Fed's hands may be tied for maybe a meeting or two, but they will react if they start to see weakness in the labor market.
Will they react if they start to see weakness in the stock market? Alan Greenspan used to say the stock market is an important barometer.
It is an important barometer. I think they have a little ways to go because of the very big back-to-back gains that you had over 22 and 24,
Brilliant.
or 23 and 24.
Is there a specific level on the S&P 500 or percent drawdown that you would need to see?
Gosh, we don't necessarily do things kind of on implied levels. I mean, 200-day moving average is what everyone looks at, but that could be a big moving target.
Right.
I think it's more a culmination of a lot of our indicators. So we have, sentiment indicators, valuation indicators, and also fundamental. The fundamental deterioration that you've seen in the market is really due to this uncertainty. It will get worse if these tariffs they are going to be imposed if they continue for a prolonged period of time.
Talk to us about the difference between the markets set up when Trump first took office in 2017 versus now, because even if you're looking at asset manager positioning, exposure to those equity futures, I mean, that's tracking above the 40th percentile coming into this year. Back in 2017, it was below the 10th percentile.
Right. Jess, that's such a good question. I'm so glad you brought it up.
That.
In 2017, it was a very different setup. So the U.S. was kind of still plodding along, having a great deal of difficulty after China devalued its currency in late 2015 and into 16. There was a big drawdown, almost 20% decline in equities, and it was struggling to kind of shake off some of that malaise. Europe actually was growing faster than the U.S. So that setup is not what you have right now, right? Equity markets have been on fire over the past 5 years, even after looking at the 2022 drawdown. And valuations are much higher, but I would also say the companies in the S&P 500 that are generating these big free cash flow, they are not terribly cyclically sensitive to the economy. However, I would say that most investors, retail and institutional investors, were very much longer equities than they were in 2017. But this is a good proper shakeout, and I think a growth scare, which we didn't have in 17.
When we're seeing the rotation more globally into European and equities in China and specifically, how long do you think that'll hold for? Because a lot of portfolio managers just maxed out their allocation toward U.S. stocks. So is this something you think is going to be more temporary or something that would hold?
I think it is temporary, as sure as night follows day. Europe will tend to have these kind of, and EFA in general, so developed international, they tend to go through these fits and starts where they have, 20% counter trend rallies. They can go on anywhere from 1 to 6 months. They draw a lot of investors in. You start hearing the cry to Europe is going to outpace the U.S. I wouldn't buy that. The valuation gap between Europe and the U.S. is actually closed at this point. Europe is no longer cheap because everyone's piled into it. So my sense is that Europe would not be a place where I'd be allocating capital at this point. I'd be still sticking to the U.S.
We say good morning to all of you across the nation here with futures. Negative 39, Dow futures negative 166. The VIX deteriorates 24.21, up 1.43 points this morning. Barbara Reinhard with us with Voya. Abby Joseph Cohen will be with us next year on confidence to be in the equity markets. Part of confidence is a 5% money market fund. I believe it's price up, yields down across the bond landscape. What does cash do when they don't enjoy 5%?
Well, I think bond yield starting to drop is actually going to be somewhat stimulative. It kind of buttresses a little bit of the tariff, probably uncertainty in the markets. It won't be able to overcome all of it. 5% is really competitive when you've got a 10-year treasury at close to 4.15, 4.18, 4.20. So cash looks like a really good thing. But I would say cash is a paradox. It's difficult to get out of it because you become so enamored with it.
Hugely.
And that is the worst thing you can do for your portfolio over the long run.
Is it difficult to get out of Mag 7 when you're so enamored with it?
That's a good question. I think the enamoring of the Mag 7 is probably the shine is off that penny at this point. But do I think that the U.S. has better earnings power, better shareholder practices, better underlying fundamentals than the rest of the world? Absolutely.
But the issue here, come on, we're talking soybeans and logs. Maybe we're talking, cars and Michael Barr's on a lather about the Windsor-Detroit Bridge. That's got nothing to do with NVIDIA, right?
It doesn't. It doesn't. But I do think that the overall landscape of tariffs will cause enough corporate CEOs to pause and to say, maybe we don't need to do that property, plant, and equipment build out. Maybe we should postpone hiring for the near term just because the visibility is low. When you don't have much visibility and you're driving a car, what do? You slow down. And that's exactly what we're concerned about.
Tom Keene bringing up those Mag 7 names. I wanted to point out, since there was so much talk last week about the Mag 7, the index in the terminal entering a correction, but most of those losses were driven more so by Tesla. I mean, that's down by more than a third in that span. And then Meta's actually higher since then, if you go back to mid-December. So how much more pain do you think in more individual stocks? Because also there's a lot of technicals for certain ones, whether you're looking at NVIDIA, where people are going to step in and buy the lows. Because even if you look at NVIDIA the last 12 months, I mean, it's still been kind of in a narrow trading range, even though you see these bounces to all-time highs and then drawdowns again.
I think the big issue is you've got a lot of concentration in the U.S. equity market. When there's concentration, it's difficult to kind of differentiate. But there are many astute portfolio managers I know that have a very good view on other parts of the Mag 7 rather than Tesla. So it's difficult to make the case that Tesla can have a really big bounce at this point, simply because I think all autos are going to kind of get washed out together with this potential tariff issue with Canada and Mexico. So I think that they're not moving in unison, and that creates more opportunity for active management.
Just mentioned the Trump put. I have no idea what that is, the Trump call or the Trump put. But let's all agree, including Trump supporters and detractors, that this president can change the script at any moment. If he comes out all Gilda Radner at the speech tonight and goes, never mind, what happens, Barbara?
I think that's a credibility issue. My sense is that he's relatively serious on this one. But there's going to be economic pain. I mean, you're talking about throwing Canada and Mexico, your north and southern neighbors, into a severe recession. That will be felt in the U.S. And there's certain things on his tariff list that there are no substitution effects for. So that's going to cause some issues. And I think the issues are, it's difficult to get the U.S. into a recession at this point. The economic strength is coming off of oil. I'd be more focused on a Fed put than I would on a Trump put at this point.
I agree with that strongly. Barbara Reinhard, this has been brilliant and a great effort into Abby Joseph Cohen. Barbara Reinhard is with Voya again.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're going to go nonstop with a person you want to listen to. Abby Joseph Cohen has an earned career through the thick and thin of the American landscape like no one else. At Columbia Business School now, off of Goldman Sachs. We're thrilled that the professor of business could join us this morning. Abby, we've been here, but we haven't. Kevin Gordon over at Schwab says these are proposed tariffs and reciprocity that go back at least to the 1940s. What does the future look like if we affect these tariffs?
Good morning, Tom. Good morning, Jessica. That's a simple question, Tom.
That's what we're doing today.
Yeah, you know what? I would disagree a little bit. It's not going back to the 1930s. It's going back to the 19th century. Tariff-based economy is something that didn't work then, didn't work in the 1930s, and I think it's very dangerous. You have had other guests on who have talked about quantifying the impact, which will be very substantial if, in fact, these tariffs hold. And it's not just the U.S. tariffs on our best neighbors and best trading partners, but also what they decide to do. I'll use the word to reciprocate, but this is a very difficult situation, obviously. The thing that is somewhat odd about this and different from what was seen in previous periods of history is these are tariffs being levied on our friends, and the blowback, the damage economically can actually be extremely severe on our own economy, even without the so-called, pushback and reciprocal nature.
To the 19th century, and folks, you've heard me talk about this, of a new Gilded Age. Maurice Obstfeld, who Abby Joseph Cohen and I worship, iconic with Rogoff and Obstfeld and Krugman in international economics, writes in the FT this morning and says it's simple. There is an inequality in America. The Gini coefficient, which is fancy math, is completely out of whack. Abby Joseph Cohen, how does Senator Grassley of Iowa or Markey of the Commonwealth of Massachusetts, how do they get us away from the Gilded Age so that we don't affect these harmful tariffs?
You have combined two very important topics, Tom. One is the inequality, which clearly is there and has worsened in recent years. We typically look at inequality based upon income, but also on wealth. And we have seen that the inequality related to wealth has actually become even more pronounced than that related to income. But what you also need to think about is how do we adjust our economy to reflect this and the power that is being wielded by those in the corporate arena, but also being assisted by the government. And you're right to say, what can the Congress do about this? And one of the things that is troubling, of course, at this point, and I'm an economic analyst, I'm a markets analyst, I'm not a political analyst, is that we don't really see the Congress getting involved in a lot of the discussions about what is happening right now. As I see it, bottom line is many of these changes, especially on tariffs, are extraordinarily painful and will be more hurtful for people at the lower end of the income and wealth spectrum.
Abby, of course, there has been ongoing debate that Trump wants to raise revenues to finance tax cuts potentially. How do you view that, and what are the repercussions with tariffs being so severe, as you mentioned, on our trading partners?
Yeah, again, I have not done the calculations myself, but looking at those people and firms that have done the calculations, there's a mismatch. The sort of revenue that would be raised from these tariffs may in fact not be all that significant, and certainly would pale in comparison with some of the tax cuts that are being discussed. So there seems to be a mismatch. The other thing to keep in mind is that when you analyze tariffs, it's a dynamic process. It's not just look at a certain percentage, in this case 25% against Mexico and Canada, and then use that number against what the imports have been. You also need to think about what will happen to those imports, what will happen to aggregate demand. And I would say that most economists would agree at this point that the sort of tariffs that are being discussed will negatively impact aggregate growth in the United States. And again, that pain will be felt most significantly by middle income and lower middle income workers in the United States.
Abby Joseph Cohen with us for an extended moment here this morning. Abby, I was at a wonderful store, Dangerous Provisions on Madison Avenue, where they've raised the price of their egg sandwich. And next to me was a student with the blue Patagonia Columbia Business School. How are you teaching tariff economics and the market impact to the students of Columbia Business School?
Once again, Tom, a very important question. And I think that we need to keep in mind that many of the students at Columbia, and they are wonderful students, about half of the people in my class were from outside the United States. And I have to say that the discussion about tariffs puzzles them just the way it puzzles many of us here in the United States. Many of them, for example, hail from countries that are quite friendly to the United States, nations that are military allies of the United States. And to use tariffs against your friends seems a little bit odd. Now, let's keep in mind that there can be an appropriate use of tariff. For example, in cases where there's dumping, where a nation is dramatically overproducing and perhaps is selling that item in the United States or another country for below the cost of production, that might be a good reason to impose a tariff. Similarly, if you're looking to protect a particular industry for national security reasons, that might be yet another reason to impose a tariff. But these widespread across the board tariffs on all items coming into a particular country, especially a country that's friendly to us, there doesn't really seem to be economic rationale behind it.
Abby, you're too young to remember this, but I had the clearest memory of October of 1987, and over a series of days, we enjoyed down 31%. We're down 6%, and we're pretty much hysterical. Have we forgotten what a correction is in the stock market?
Tom, yes, I do remember that day. And one of the big differences between October of that year is that that big decline had to do with internal mechanics within the stock market. I think that one of the reasons people are so concerned right now is not just the dollar amount or the percentage amount or the rise in the VIX, it's the economic uncertainty. Back in 1987, there was no economic change that had triggered that particular decline, and so it was quickly reversed. I think what people are concerned about now is that there is true uncertainty with regard to economic policy, and there doesn't really seem to be a clear rationale, economic rationale, behind the numbers that have been thrown out vis-a-vis a 25% increase in tariff. In addition, we're facing uncertainty with regard to whether the continuing resolution that has kept the federal government working, it will expire March 14th. We do not yet have a new budget in place. So that's another area of uncertainty. One of the things, however, that I'm looking at very closely are not some of these things right on the news flow, but rather the long-term issues. And something that I don't think is getting enough attention is that decisions made by the Trump administration are damaging the long-term status of the United States as a scientific and technological leader. We're basically cutting off at the knees a lot of the work that's being done by leading scientists in the U.S. government and also in U.S. universities.
I look, Abby, where we are. I got to be quick here because just Matt wants to get in. We're going to have headlines out of Mexico here. President Sheinbaum is speaking right now and announcing, quote, countermeasures on a Sunday. How do you be comfortable long-term investment, Abby, owning securities here? I don't want you to, redo what David Costin's working with this morning at your Goldman Sachs, always your Goldman Sachs. But just in general, how do we have comfort with equities as a long-term opportunity?
Right now, I think we need to kind of sit back and see which way policy is moving. And then, of course, we can apply the models. As you well know, the long-term benefit of investing in the United States has been related to the strength of our economy, including the long-term investment that is made by companies in CapEx, also the investment that's made in information, whether that's education at the K through 12 level or at the university level, but also, as I mentioned before, our willingness as a nation to invest in the future by funding places like NIH and the National Science Foundation and NOAA and CDC. And I think that many investors ought to be paying attention to whether the Trump administration will reduce those cutbacks and, in fact, I hope reverse them because they make no economic sense.
What else potentially could be coming from the White House when it comes to trade policy? Because you were mentioning that March 14th deadline for the government to avert a shutdown, but then on March 12th, just next week as well, 25% tariffs on all steel and aluminum imports are also set to come.
Yeah. Now, one thing that I don't know, again, I'm an economic analyst, a markets analyst, not a political analyst, is I don't know what the game theory is behind this. There are some people who are postulating that the 25% numbers that were picked out for tariffs were designed basically to be an opening bid, if you will, for negotiations with various countries. So where we end up, I don't know,
Right.
but I think to kind of throw the gauntlet down in front of nations that have been cooperative with us
Right.
over the years, that have their own economies intertwined with ours. This is
Right.
not a mercantilist economy. We are highly dependent upon these interrelationships that we have, and many of these
Right.
tariffs will damage us very significantly.
Abby, in the time we got left, I got to interrupt you. I mean, you're working a hard 15-hour week up at Columbia Business School. Let's be honest, Abby Joseph Cohen, you could slide right over to be vice chairman of the Fed, or dare I say, chairman of the Fed in a heartbeat, given the moment, the politics of the nation. How should Jerome Powell respond to this moment?
I think Mr. Powell and the other members of the FOMC need to be doing what they have been doing, and that is to focus on the data and to keep in mind the dual mandate of inflation, but also employment. And one of the things that has been terrific throughout the Biden administration has been this ongoing creation of jobs, and then the increase in the average wage adjusted for inflation for the American family. They will be watching at the Fed whether that good news continues. If we see an erosion in the labor markets, if we see an erosion in wages adjusted for inflation, I think at that point they're going to need to adjust the policy and provide some stimulus to basically offset some of these policy decisions coming out of the White House.
Interesting. And of course, folks, that's the first we've heard this morning, and always what you hear from Abby Joseph Cohen about wages, both wages and real wages, given rising inflation, is being part of the Fed calculus. She is at Columbia Business School, of course, forever with Goldman Sachs. Abby Joseph Cohen, thank you so much. Extended comments this morning.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Without question, this is our conversation of the day. Jean Bovin is out of Université de Montreal and Princeton University. He is definitive on his Canada and their economics. He is the head of BlackRock Investment Institute. But today is different. We speak to Jean Bovin about what is occurring between Detroit and Windsor, Ontario. Jean, you know the landscape better than anyone. If I look at reciprocity across that bridge between Windsor and Detroit, what's Doug Ford going to do? Mr. Trudeau, the future Mr. Trudeau, what are they going to do on a reciprocal basis against what Mr. Trump is doing?
Well, good morning, Tom. Good morning, Jess. It's a pleasure to be here. Yeah, I think, we've already started to see reciprocity at play today. And I think there is, from what they've been saying pretty clearly, I think there'll be funding in kind, I guess, over the as things go. So that's the first step. I don't know. I mean, I think we're all learning as we go here what's going to be the of these things, but in terms of the intent of responding, I think there's no doubt that this is the current stance there, and so we'll see what happens in response in the U.S. after that as well.
Jean Bovin, we studied very carefully Ken Rogoff and, of course, Maurice Obstfeld out at Berkeley. Professor Obstfeld writes an absolutely blistering op-ed released about 4 hours ago in the Financial Times. It's like Berkeley 101, Jean. You can appreciate that. You're a freshman at Princeton, and it's like, oh, it's complicated. Professor Obstfeld makes clear the simplicity of the Trump administration has no academic grounding. Where is the part where President Trump is being too simplistic?
Well, I think I'll confess I didn't have a chance yet to read.
Of course.
I will. But I think it is a fact that when it comes to trade, we have like very good models to think about, like, more static, train pattern, and like, we go back to Ricardo, but the reality is a lot more complex with trade, and what's going to be the ultimate macro effect on growth, for instance, I think is a bit difficult for academics to agree. I think the inflation impact is pretty clear. I think that you're going to find consensus there, but more broadly than that, I think it's harder. And I think it all depends also on what is the objective of these tariffs.
Right.
I mean, are we talking about fiscal revenue generation? Could be an objective. Are we talking about trade balances? I think one thing that is not fully appreciated is that these two objectives work against each other. If you really are trying to maximize tax revenues, you're going to have to live with a wider trade balance. So I think more than what the academic conclusion would be, I think is the lack of clear understanding of what are we doing here that
Right.
I think creates certainly a huge amount of uncertainty.
And to frame this out, Jess Matten, the Atlanta GDP is a headline making negative 2.8%. And a lot of people, including Hatsius and the team over at Goldman Sachs, are saying it's actually still diminished, but somewhere in the zero, even up as high as positive 1.6. So there's a real argument about the growth dynamic.
Right, in the volatility that we see. So, Sean, I mean, you were actually previously appointed as deputy governor of the Bank of Canada. And of course, we're looking at how Canada retaliated, putting tariffs on $107 billion of U.S. products. So your view when it comes to the Bank of Canada and when it comes to the direction of interest rates, we're looking at overnight swaps, increasing those bets that the Bank of Canada will cut rates by 25 basis points at its March 12th meeting. So how do you view this when it comes to central bank policy?
Yeah, so I think the starting point here is that, and this is not what the market is currently pricing, but I strongly believe that this is a stagflationary shock, right? I'm not saying we have stagflation, but I think the shock itself, these kinds of measures, are stagflationary. They're pushing growth down and they're pushing inflation up, and I think that makes it tricky because from the U.S. perspective, like the yields are falling. We had like 50 basis points of decline in 10 years over the last month. And I think that has been interpreted mostly as a growth shock. I think what's going to be the wake-up call over the next few weeks is that like inflation is going to be the other part of the other leg of that story, and that's going to complicate the rate kind of landscape. Right. So I think on the U.S. side, it's not clear that to us that there's going to be much room to cut rates. For Canada, the complication is that there's like now a weak Canadian dollar dynamic, a weak loonie, which is like a massive issue for the central bank. So I mean, as long as this, or they all say that as long as it's orderly, there's no gapping in currencies, that's not the objective. But I think like once you get to the level we're seeing right now, it's going to be an additional concern. So even though it's a stagflationary shock, on top of that, you have a weak dollar. So I think the knee-jerk reaction will be to cut. But I think that's going to be much more messy and complicated. And I think it's a given that we have an easing cycle coming out of this in Canada.
Bloomberg surveillance this morning across the nation, across Canada as well. Thank you for listening on Apple CarPlay, Android Auto, on YouTube. Subscribe to Bloomberg Podcasts, growing each and every day. Major shout out to David Weston in his conversation on Friday with the Treasury Secretary of the United States that had over 3 million downloads on our digital platform in a matter of hours. Jess, a final question, please, to Dr. Boivin.
As far as when it comes to the economy, what do you think is the biggest risk when obviously we're continuing to talk about tariffs, but what's the follow through here?
Yeah, so I think this is an environment with, I don't think I've ever seen an environment where there's so many moving parts over which you have as wide a range of views from the commentators on how they're going to play out. So I think this is very unusual. To me, the most important thing to watch is that, as I said, I think this is mostly a stagflationary shock where the tariff piece. Inflation was not a resolved issue from our perspective. So it's adding a layer to something that was already a problem. And then we're going to have the fiscal side of things that's going to play out over next week, right? So we're going to have the discussion, government shutdown potentially. So the waking up of this is stagflationary in nature plus a fiscal story that I think will be expansionary. Those two things where when you see the yields at 4.13 on the 10-year, I think that raises questions. And to me, that's the much.
Jean, thank you so much here on Short Notice. Really, really appreciate your attendance today. He is with BlackRock. We hope to get Dr. Boivin in our studios for an extended conversation here in the coming week. Sean Bovin is with BlackRock.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're looking at the 3-month correlation of no eggs at Costco with our newspaper report this morning. Lisa Mateo. Oh, Lisa, are there eggs in aisle 6?
There are eggs, but paying more as usual. And speaking of paying more, this is kind of a look into what products are going to be, you're going to be paying more. The Washington Post did this analysis. It was like international trade data from the Census Bureau. So this is a breakdown. Stick with me because there's some numbers here. So we start with China, right? The main source of imported consumer goods, sending about $210 billion worth of everyday household to the U.S. in 2023. So what does that mean? It means electronics, clothing like cotton shirts, shoes, kids' toys, things like that. Then you get to the grocery aisle. About $9.9 billion worth of vegetables, more than $11 billion worth of fruit and frozen juices come from Mexico in 2023.
Wait, what about the beer?
And then, then you have avocados, right? The beer, tequila. You can't forget the tequila, Jess. And then we talked about cars, right? We've been talking about cars, Canada and Mexico. The U.S. also imported $93 billion worth of crude oil from Canada in 2023. So it's kind of this good breakdown of what you can possibly pay more for.
It's going to be, I think it's unknown. The uncertainty here is off the chart. Some of the research notes I mentioned, George Saravelis at Deutsche Bank with a blistering note like 10 minutes ago, and we'll get more in. Futures deteriorate now, new lows, negative 37. Another story, Lisa,
Yeah,
please.
so Tom, you always tease me about looking for gluten-free products, right? So how about tariff-free products?
A what?
Tariff-free.
Oh,
yes.
tariff-free.
Yes. So these are the signs. Yes, with a T. It's happening at this Housewares trade show in Chicago, the Inspired Home Show. So a lot of the booths are posting these signs that say tariff-free because they're trying to attract new customers. One company did it. He said that they actually helped him land new customers. He started changing up some of the things he does with this company, but he says that is starting to help. So you might start seeing some of these signs, as.
What do you think, Jess? I mean, you're the Texas girl here. I mean, Texas is booming. Let's all agree on that. What does the Mexican border slowdown do now to Texas?
Well,
and the answer is it's ginormous.
Well, it is ginormous. I grew up in South Texas, so especially when it comes to a lot of the hospitality, construction jobs, as well as landscaping, that's a big question mark is what it means for some of those smaller businesses that depend on some of that labor and what it means for if it's not as cheap as far as how that feeds in to their businesses, as well as wage inflation.
So can we get one more in?
Yeah, one more. So we heard about Target, right? The CEO saying that he was going to start having to increase prices, especially fruits, vegetables, things like that. But the CEO of Chipotle actually told NBC Nightly News that they are going to foot the bill for any cost increases from tariffs. He said for now, that's what they intend to do because their economic model can withstand it. But he did add that pricing changes could eventually come if those costs become a, quote, significant headwind. And when we're talking about the avocados, they actually get 50% of their avocados from Mexico, but they also have the rest coming from Colombia, Peru, Dominican Republic too. So that might help out. But he estimated the cost of goods increasing 0.6% on a rolling basis from tariffs. But he says right now, they're not going to pass that on to the consumer.
Lisa Mateo, thank you so much on the newspapers.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.